What about CPD? Now, we're familiar with CPD, obviously, because of our knowledge of ACCA and how it works post-qualification. CPD is simply the idea that we sort of keep skills and competencies, if you will, up to date on a regular basis. So really, what we're saying is that companies should provide resources. They could be video recordings, manuals, courses, etc., for developing and refreshing knowledge and skills of the directors, including NEDs. Okay, this is key. Let's keep them up to date, for example, with changes in compliance or indeed any other area. Next key point is performance appraisals. And again, this is something that you will be familiar with perhaps in your own careers. So what do we think in relation to executive directors and indeed NEDs? Clearly, we want to have appraisals that focus on maximizing strengths and indeed tackling weaknesses. Performance appraisals aren't about punishing people or about admonishing people. They're about helping people to understand how they've done, where they're at, and how they can grow going forward. So what sort of areas should we be considering in relation to evaluation of executive directors or indeed non-executives in some form of appraisal? As you would expect, the appropriateness of their experience, knowledge, and skills. It's on the one hand, clearly it's simple enough to assess an individual based on a curriculum vitae, a set of interviews, etc. But the bottom line is there's nothing like doing it. There's nothing like practical work. So really, a performance appraisal, particularly the first performance appraisal, will give an idea of the sort of what's said on paper versus what has actually happened over the last 6 months, year, or whatever. Next key point is succession planning. Now, we should be aware that all that we're talking about there is planning for the future in terms of personnel, okay? So this evaluation should include this, if necessary. Not all performance appraisals will involve discussion of what's down the line, what's in the future, how this individual is being lined up, but some will. As we said up top, in terms of maximizing strengths and tackling weaknesses, certainly the appraiser should look at gaps and indeed how to address them. Next key point is, a communication and how important that is, a recognition on behalf of the individual, that communication with other stakeholders is absolutely key. So let's assess how this individual does that. And indeed, linked into that, the link in with committees, board committees, depending on whether or not this individual is involved with board committees, and indeed their effectiveness within that committee. Next key point for us is, if we were talking about, let's say, evaluating the board as a whole, we'll see down below, we're going to suggest ways that we might evaluate NEDs or even individual directors. But if we're looking at evaluating the board, then what sort of questions would we ask? Well, the first key point is performance against objectives. We're talking about performance against corporate objectives, stated, outlined corporate objectives. That's key, because if a board isn't performing well against stated corporate objectives, there is a major problem. So that's question number one. The next key question is, in terms of, let's just say that we have a board that would appear to be performing very, very well against stated corporate objectives. The next point is, is the business in line with its mission and indeed vision and values? In other words, are these objectives, for example, are they being achieved in line with our given values? Because if they're not, then that is an issue. It's all well and good having high profits, increased revenues, etc., but if the values of the business aren't in play and being adhered to on a day-by-day basis, then that's an issue. And it's the same goes for the mission of the business, i.e. its purpose, and indeed the vision. So those are the two questions in terms of, let's say, if we were to broadly evaluate a board. What about NEDs? Now, as I said earlier on, this can be applied to executive directors as well. What sort of questions would we employ if we're looking to evaluate NEDs? Well, first one, really, is, are they well prepared, for board meetings? And indeed, is their meeting attendance satisfactory? Second key point in terms of evaluation of NEDs, do they seem or appear to have, enough time to devote to the role? We said up top, that's an issue. If they haven't got enough time, doing their role correctly is going to be difficult. And indeed, effort, are they making an effort? Next key point for us is really diversity. Now, we've touched on this already. We said that diversity actually sort of comes in sort of two different levels. The basic level, as we'll touch on in a second, and indeed perhaps some more higher end levels. So first things first, really, this idea of bringing in board members of different genders, different ages and different ethnicity is very, very important, because we're bringing in different ideas. The bottom line is that someone who's been in business for 30, 40 years, who's been working in New York, who's Australian, is going to have different views to someone who's 30, who has been working in London, who's been involved in a different industry. The bottom line is, we bring in diversity, it's highly likely that we bring in better discussion, more ideas, more creativity, etc. So that's the first side, and if you will, the sort of basic side. But in addition to that, things like personality and expertise in different functions and indeed different industry, these are also key. So do remember that diversity doesn't just mean having someone who's female and from a different race on the board. It means a variety of other things. Next area for us is really, given that, what would be the main benefits? Well, certainly, I think, broadly speaking, and we're generalizing, that if we have diversity, if we have different people from different backgrounds, different sexes, different ages and races, then it's very probable that the decision-making process will result in better decisions. The second area for us is, as we said in point number one, the decision-making process will be better because you're getting a breadth of perspectives. You're getting different perspectives as opposed to having just the same people who've come from the same country or same city and who are all accountants or accountants and lawyers. You're not getting a breadth of perspective at all. Outside of that, as we mentioned up top, certainly what diversity will bring is the possibility of bringing in expertise from functions that we don't have enough expertise in, whatever that is. It could be IT, marketing, etc., etc. You can pick and choose, subject to, obviously, the availability of the right sort of people. As we said up top, that's an issue. Now, what about challenges? Well, certainly, we mentioned the word conflict up top, conflict between NEDs and executive directors. Conflict and friction is inevitable, but it's particularly more likely where you bring in more diverse groups, people from different areas, different ideas, different backgrounds, ages, sexes, etc. So, the challenge is, this cannot be avoided. You are going to have friction, but in one sense, that's the reason why we should have diversity, because, for different views, maybe to create friction deliberately. The next key point is tokenism. Now, what I mean by that is that some would suggest, and there have been examples of this in the press over the years, that really, someone is being brought in, again, with respect. Let's just say that the board is predominantly male and a female director is brought in. Some people would say, well, it's just window dressing. It's just to make things look good. It's just a token gesture. But this particular person, this particular woman is not being listened to. That's not a good thing. Well, what we can't have is tokenism. We've got to be bringing on NEDs and bringing on board members who bring something to the party. They can't just be there to make things look good. Tokenism is not a good idea. Let's try and remember that word. Next area for us is committees. Now, we know that in relation to NEDs, they bring a variety of different things to the business. And generally speaking, they bring expertise to the myriad of committees that are broadly required under a corporate governance regime. So, in terms of a committee, what do we mean? Well, a committee is, in essence, just a group of people that have authority delegated to them to perform a particular function or duty. And as we'll see later on, there are 4 main committees under the banner of corporate governance. Now, in terms of outside of that sort of key definition, clearly committees are going to bring a breadth. They're going to bring breadth because they will involve not just executive directors, but also non-executive directors with different perspectives. Last key area is clearly they're going to bring expertise in different areas in terms of the functional side, whatever that is. Now, in terms of governance, broadly speaking, as I've said, 4 key committees. Now, of these, as we see in a moment, probably the audit committee is the most important for a variety of different reasons. Most corporate governance regimes would suggest that a remuneration, nominations, and audit committee are the key requirements. Sometimes, depending upon the business, a risk committee's work is covered by the audit committee. But a little bit more on the audit committee, really, certainly the most important. The audit committee deals with the integrity of the internal controls in the business and indeed risk management and financial reporting. These areas are crucial. The internal control system, liaising with internal audit, etc., identifying, evaluating and prioritizing risk, and the whole area of reporting, absolutely critical. Now, in terms of the first committee up top, the Remuneration Committee, I think we know what this is, and we've said that there's really 2 sides to remuneration for a business. The first side is making sure that we attract the right directors with the right skills. You've got to pay them properly. Their rates, their financial packages have to be commensurate with market rates. Otherwise, the quality drops. The second side, obviously, is we need to be careful because we can't have too much influence on behalf of, let's say, executive directors in their own packages, in devising their own packages. We have to have some sort of standoff there and indeed control, hence the existence of remuneration committees. So what's the background over and above that? What does this committee do? Well, certainly deals with remuneration policy and indeed the devising of contracts for board members and key executives. In addition to that, note, this committee is comprised generally wholly of independent directors, so of NEDs. No executive directors on this committee at all. So that gives that separation, as mentioned, that we need. Okay, sometimes a majority, but generally speaking, it's preferred that this committee is wholly NEDs. Linked into that really is an area that we've seen reference to many times, the ICGN, the principles relevant to this area of remuneration and indeed remuneration committee. So I'll just run down a few of these. This is what the guidance that we get from ICGN. So they suggest that what this remuneration committee should be doing is certainly determining and recommending remuneration philosophy and indeed policy. Outside of that, excuse me. Outside of that, designing, implementing, share-based incentive and other benefit schemes, including pensions for all executives. Ensuring that conflicts of interest among committee members and between the committee and its advisors are identified and avoided. In other words, conflicts of interest, anything to do with, let's say, a suggestion that a given remuneration package is okay, a suggestion by one party, whereas another party suggests that it isn't, and it may well be that there's some element of bias there. Next key point is appointing any independent remuneration consultant, including their selection in terms of engagements. Really, when we think of independent, we're looking to bring in some expertise in the area of remuneration to guide us. So this is the NEDs, as it were, employing another person, an external consultant, to assist with the process. And then linked into that, certainly, maintaining communication with shareholders on the subject of remuneration. So it may well be that from time to time, certain shareholders have some issues or some current concerns or perhaps some questions in relation to a certain area of the remuneration process or policy. And this committee is there to answer those concerns or those questions. So that's the principles. Again, nothing too much over and above what we saw up top. Just sort of some good common sense, some good business sense. Now, in terms of the advantages associated with having a remuneration committee, what if it wasn't there? What would we be losing out on? Well, really, what we have is a situation where remuneration levels for executive directors are really set outside of their sphere. We do not have, as we used to have, unfortunately, executive directors deciding upon their own pay. That gives not only shareholders, but also other stakeholders some comfort. Absolutely. Next key point is that certainly this provides a transparent system. Remember that we've got broadly NEDs only. They're tasked with doing everything, deciding on contracts, deciding on pay levels, possibly employing independent remuneration consultants, liaising with shareholders, other stakeholders if they have concerns. This is very much a bulletproof, transparent system for executive remuneration levels. Next key advantage is really, as I've said up top, it's one thing monitoring and being careful with executive directors, but they have to be rewarded fairly and indeed according to market standards. Why? Well, if you want good quality high-end executive directors, you need to pay them properly. So this is absolutely key and is the balance really to the other areas of concern that we raised. So those are the key advantages. What about the nominations committee? Now, as mentioned up top, it sort of does what it says in the tin. We're really talking about a committee that is tasked with sort of selecting, recruiting, finding executive directors and keeping them in play within the business, and indeed possibly at the back end maybe dismissing them or getting rid of them. What's the background to this particular area? Well, per the study hub, you'll see that certainly in the 1990s in listed companies, there's this reference to the old boys network. So really the origins or beginnings of the cry for nominations committee was such that really in listed companies, in the boards of listed companies in the 1990s, certainly in the UK, there was a suggestion that really nominations to the boards were based on not so much what you know, but who you know. In other words, it's a sort of a closed shop. And that wasn't good for businesses. Yeah, we had too many old boys, as it were. So what we needed to do is to find a system to widen that selection process, hence the nominations committee. What about the duties? Now, quite a lot of information here. Let me take you through some of it. What does this, or what are they supposed to do? Okay, well, certainly, evaluate the balance of skills, knowledge, and expertise. And if there is an imbalance, then obviously to try and plug it, to fill that gap, to appoint someone. Outside of that, to consider the ratio. Remember that certainly under the UK code, it should broadly be 50-50, 50% executive, 50% NEDs. Certainly to ensure transparent procedures. Outside of that, to make sure there is evaluation, of the board and indeed individual members on a regular basis. In addition to that, we touched on sort of selection and recruitment. Searching widely for appropriate candidates to fit suitable selection criteria. Next point is ensuring new board members received proper orientation and training. We touched up top about induction and indeed down the line performance appraisal. That is key. And indeed preparing for the future, preparing for succession planning. The nomination committee will be involved certainly in appraisals, but also considering how different individuals may be suited to different roles down the line. So given that, what are the advantages of having a nominations committee, and what would we lose if we didn't have one? Well, the first obvious thing is their independence in terms of the selection procedure. We get away from this idea of the old boys network and perhaps members of executive boards choosing their friends, school friends, old colleagues, etc. Sort of like a closed shop. We avoid that entirely, okay? Next key advantage really is that this role of selection, recruitment, interviewing, etc., takes a lot of time. By having a nominations committee, we allow senior executives to run the business, to focus or concentrate on running the business. They don't have the headache. Next key advantage and final one is that we avoid the idea of the selection process being controlled, or to use the word here, captured by an individual. It might be the CEO, it could be someone else, but really we allow independence to creep into this process, and the idea that this procedure of bringing new people in, or indeed getting rid of people, really is dealt with on a fully independent and standalone basis. That has to be a good thing for businesses. Next key point is the audit committee. Now, as mentioned up top, generally speaking, for listed companies, 4 committees. So nominations, remuneration, risk, and audit. Now, audit, as mentioned, the most important one because of the role. I mean, the audit committee is tasked with really ensuring that the outputs from the business, particularly in a reporting sense, and indeed the systems, internal controls, risk assessment, etc., are bulletproof. Now, as mentioned also, we touched on the risk committee. More often than not, depending on the business, the risk committee's work is dealt with by the audit committee. If the business is too busy, if the audit committee is overrun, sometimes you'll see all 4 committees, including the risk. So what's the background to the sort of audit committee? Well, it does in the UK certainly go back to the early 90s, but broadly speaking, the audit committee, or the existence of the audit committee, is linked with the origins of corporate governance worldwide. So for example, in the US, albeit it's around about 10 years later than corporate governance was given its birth in the UK, Enron in 2001 went belly up due to a variety of factors, not least creative accounting, off-balance sheet financing, and unfortunately the collusion between the executive directors and indeed the auditors, Arthur Andersen. So really, the origins of the audit committee are broadly speaking set in very, very poor judgment and indeed business practices by a variety of executive directors, normally scandals. Now, the role, according to the OECD, my apologies, according to the OECD, the internal auditors, and this is absolutely key because everything stems from the internal auditing, internal control system. Good practice of the internal auditors to report to an independent audit committee of the board. So really, what the audit committee provide is an independent sort of function, as it were, for internal auditors to report to. Without the audit committee, they do not have that. In terms of SOX, what the audit committee should be doing is to provide, as mentioned before, a sort of a check and balance on the whole financial reporting system. Okay? Let's move on from there. Outside of what we just said, the role. Well, certainly the independent review of financial statements and reporting. certainly to impact, maybe not decide on accounting policies, but assist with the decisions with regard to accounting policies. Linked into that, there's a key issue here in relation to the appointment of external auditors. This is a key function of any audit committee, is to appoint and indeed monitor the sort of performance of the external auditors. Okay. Fourth key point, I mentioned this already, the company's financial controls, the internal control system, to review them, to monitor them, and indeed to liaise with the internal audit department about their efficiency and indeed their operation. And indeed, really to oversee the workings of internal audit themselves, review and monitor the effectiveness of internal audit. For a committee to be efficient, we need a properly functioning internal audit group as well. In terms of composition, several points here. Obviously, it's slightly different under a rules-based or SOX approach than it is for the UK, as an example, principles-based. So under SOX, a couple of key points. A member shouldn't accept any fees other than remuneration as director, and certainly shouldn't have any affiliation or relationship with the company or any other subsidiary. In other words, a member of the audit committee. Indeed, under the UK code, ideally 3 non-executive directors on that committee only. No executive directors at all. Okay. Next area for us is risk committee. Now, I've mentioned the risk committee already. Let's take a look at some detail here. So first things first, really, in terms of the company's size and risk profile, it may be appropriate to have a risk committee, a standalone risk committee. Smaller listed entities, even medium-sized listed entities, tend not to have one. As mentioned, their role, their duties is taken on by the audit committee. So what are the role or what are the duties of a risk committee? My apologies. Several things, several areas here, quite a lot to discuss. So certainly approval of the risk management strategy and policies. So the idea of the process of identifying the key risks, assessing their likelihood, stroke probability, and indeed impact, and really managing forward, perhaps in line with the management systems such as TARA, transfer, avoid, reduce, accept. Okay, so that's point number 1. In addition, point number 2, we need to be aware, and we've seen this referenced up top, the risk committee needs to understand the possibly differing risk appetites of different parties or stakeholders within the business. The directors, stroke shareholders, stroke other stakeholders. So, they need to define the risk appetite and try to ensure that decisions are made in an appropriate way. Outside of that, as mentioned in number 1, certainly the review of the procedures for managing risks. That is a key role for the audit committee. Everything from identification, measurement, reporting, mitigation, etc. In addition to that, the sort of guidance role or advisory role to the board. The members of the risk committee will be experts in this area. So it's an ideal situation, certainly for larger companies to be in, to have this risk committee. And indeed, final point is just keeping their eyes open, monitoring overall exposure to risks of all kinds, whether or not they be large, medium, or indeed small or insignificant. Next area for us is really advantages. If we didn't have a risk committee, what we'd be losing out on? Well, again, scrutiny, scrutiny from a risk perspective. In addition to that, we know that this risk committee will certainly not allow any vested interests of executive directors to sway their view or to sway their actions in the same way that, let's say, an audit committee wouldn't either. And then last key point, we're bringing in expertise. If you're on a risk committee, you've probably been on other risk committees. You're an expert in the area of evaluating, managing, identifying risks. That is key to any business. What about disadvantages? Well, disadvantages, are such that really, in the same way that not having the vested interests of executive directors involved in this process, really, executive directors have direct knowledge of the business. They're involved in the day-to-day runnings of the business and may have well been so for many, many years. Without their input, you have no direct knowledge or experience of the risk. So you really have a group or a set of individuals really coming to the area of risk for a business new, possibly uninformed, notwithstanding their experience and indeed their expertise. What about the second disadvantage? Well, really, because we know that members of indeed all committees are not full-time employees, they will only meet periodically. So it could well be that having a risk committee involved in dealing with all aspects of risk for a business creates time delays. There may be a risk that's emerged, and indeed the risk committee, are not due to meet until the end of the month. So, taking action by the board is going to be delayed. It's going to be much more difficult. Okay? So that's a problem. In terms of other issues in relation to this risk committee, I guess, developing and implementing meaningful definitions of risk. The external environment changes from time to time, and indeed the risks that a business face change. So this discussion needs to be in play on a regular basis. Outside of that, this idea of the non-financial risks, these are important. Generally speaking, when we think of risks, often people put numbers to them, but sort of understanding this area is also important, and also the changing way that an individual company's capacity and indeed profile, attitude towards the risk can move from time to time. In addition to that, given their role specific to risks, getting business unit managers to take ownership, forcing them to act on the basis of your advice could be difficult, particularly if the risk committee is new. In addition to that, raising level of awareness across the entire organization. Again, if the risk committee is new to the business, trying to make people more aware of the problem, or let's say a new risk emerges and trying to get them to take you seriously, could be an issue. Final point, having enough time to thoroughly and strategically review the risk assessment. Again, these individuals on the risk committee will not be full-time. They will meet periodically, and it could well be that the business is extremely large. It's in a dynamic business environment. So, having the time to do the job properly, is an issue in point. Let's move on from there. Remuneration. Now, again, we've said that there's two sides to remuneration in terms of the board and indeed executive directors in particular. Those two sides were really, attracting the right people, paying them enough. If we don't pay enough, if our financial packages for executive directors are not attractive enough, we're not going to get top quality executive directors. The flip side is, making these packages reasonable, and also limiting the degree to which executive directors can impact upon their own financial packages. So there we go. So firstly, attracting the right individuals, right skills. You've got to pay them enough. In addition to that, alignment. The idea that remuneration should be aligned with the long-term benefit of the company and stakeholders and shareholders. So we're talking about things like the corporate objectives, maximization shareholder wealth. A balance is needed. And in addition to that, that's actually just a double there, my apologies. Let's move on to ICGN principles on this area. So according to the ICGN, there are a number of key points. And again, a little bit of repetition here. Firstly, really alignment, okay? Alignment with overall corporate objectives. The second key point is performance. Certainly, we need to be able to compare the performance of the company with stated overall corporate objectives, and indeed performance-related elements should tie into that. Third key point is disclosure. Certainly transparency and making the remuneration policy 100% clear to all parties is absolutely key. Next key point is in relation to share ownership, the policy should be very, very clear. This is key because obviously shares can form a massive part of financial packages, particularly for large listed entities. Next key point is approval. Certainly shareholders should be communicated with and have the opportunity to vote on remuneration policies, particularly when they involve share remuneration plans. Okay. Next key point for us is really this area of the possibility of inclusion of performance-related pay. So linking in, I guess, packages to how these individuals perform and indeed how the company performs. This reference to long-term versus short-term is certainly important. I've mentioned short-termism several times. A balance needs to be had between short and long term. If we think about it, perhaps we could say that directors would be more inclined to want short-term gain next month, next quarter, this year. Whereas, broadly speaking, other stakeholders, including shareholders, might be more keen for long-term. So a balance needs to be had between the two in terms of linking performance of the business of the individual directors into pay. In terms of share-based schemes, again, as we see, looking at packages and how they've developed over the years, share-based schemes or share-based incentives are certainly a big part of modern-day financial packages and have been so for some time. I'm talking about things like share options as an example. So first things first, and again, there's some repetition here. The share-based incentives, if you're giving shares to individuals as part of their remuneration package, they certainly should align the two interests, i.e. the interests of the directors with shareholders and performance. Outside of that, in normal circumstances, shares granted or other forms of sort of deferred remuneration should not vest, and options should be not exercised in less than 3 years. So what we mean by that is a typical share option scheme will be, let's say, agreed upon and granted to an individual director on paper on day one. What the suggestion here is that should not crystallize. In other words, the individual concerned should not be able to sort of avail of that benefit or cash in, as it were, for at least 3 years. Okay? In other words, in normal share option scheme, you would grant it on paper at the outset, but you would actually be able to have access to the shares in 3 years or so, or later than that. And that obviously keeps people interested in, and it doesn't create a situation where perhaps executives are arriving and leaving every 6 months to a year. Next key point, that certainly, outside of the 3 years, directors should be encouraged to hold their shares for a further period after vesting, or indeed exercise. So in relation to point 2, yes, let's have a minimum of 3 years, but there should be some sort of way to encourage directors to be staying on for longer than that. In relation to point number 4, certainly the criteria embedded in these share agreements or share ops agreements should reflect the company's performance relative to a group of comparable companies with some key variables. Okay, possible measures, shareholder return, EPS, net profits, etc. Okay. Final point is that grants under sort of employee stock option plans and other long-term incentive plans should normally be phased. In other words, rather than voting plans or indeed options in one foul swoop right now today, they should be phased over several years. Similar point to what we said up top. This is really, in one sense, to quite cutely tie individual directors into the company over a period of time. Next area for us is determining directors' remuneration. How do we do that? Well, we know the basic elements. We know that director remunerations could be made up of a number of different things, but certainly, the market is going to have a big say in that. And what do we mean by that? Well, when we think about the market, I mean, this market rate of pay, if we're trying to attract the right people with the right skills, high-end executive directors, then certainly we need to pay them well. What's going to influence on that? Well, certainly the size of the company, the industry itself. Is it dynamic? Is it fast-moving? Is it tech side, etc.? Generally, the packages might be more attractive in those areas. Certainly the company performance, is it doing extremely well or maybe not so well? And obviously the CV, the director's experience. So that's going to impact upon what we decide to pay this individual director, for sure. What about strategic issues in terms of this pay area? Well, several things to consider, particularly when we think about performance related or indeed, share incentive plans, etc., as to whether or not, schemes should be individual or group or possibly a combination of both. In addition to that, we've mentioned performance of the director, but also obviously performance of the company being absolutely key. We've got to think about, well, do we include or should we include not just financial measures, but also non-financial measures? And we know how important non-financial KPIs, non-financial metrics have become over the last 10 or 20 years. I mean, thinking of things like the balanced scorecard as an example. In addition to that, we have to be careful if we're incentivizing staff with these packages. We need to make the targets reasonable, challenging, but achievable. They can't be unobtainable. That's demotivational. But also, they can't be easy to achieve. So several factors there, certainly the market impacting, but also strategic decisions as well. Okay, so this really concludes chapter 7 for us. As I say, quite a large chapter for us. Some important areas there, particularly in relation to the committees. Absolutely. And indeed, with specific reference to NEDs, their role, what they do, their importance. Okay, I hope you found it helpful and indeed that you'll join me on the next chapter.